With the first quarter of 2024 in the books, three primary themes emerged. First, economic resilience despite higher interest rates, a broadening of the equity market rally beyond the Magnificent Seven stocks, and third, central banks push pause on interest rate cut expectations. We'll dive into these shortly, so warm up the edge of your seat. But first, let's chat about market performance. The first quarter of 2024 was productive for investors as well as for Matco's investment platform. Equity markets continued to trend higher, while fixed income investors will need to be a little bit more patient to see rates move lower and bond prices move higher. In descending order, our Series F fund performance for the first quarter. First, our Matco Small Cap Fund was up 11.4%. Matco's Global Equity Fund was up 10.7%. Our Canadian Equity Income Fund up 6%. Matco's Balance Fund up 3.8%, and lastly, our Fixed Income Fund down 1.6%. Now let's dive into the most important developments from the first quarter. First, economic resilience. What exactly do we mean by this? The labor market remains healthy. Through the first quarter, the Canadian economy produced 75,800 net new jobs, while the US economy produced 829,000 net new jobs. Both numbers remain above trend. Second, wage growth and consumer activity remain strong in the face of higher borrowing costs. The current elevated interest rates beginning to pinch consumer spending may in fact be on the horizon, but have yet to surface in a meaningful way. Lastly, corporate profit growth. In the US, fourth quarter profits showed growth of 4.0%, and in Canada, fourth quarter profits declined by 1.1%. This segues us nicely into the broadening of the stock market rally. Throughout 2023, markets were propelled higher. However, market growth was driven by a disproportionately low number of stocks. In addition, smaller companies underperformed their larger counterparts. In the first quarter of 2024, this leadership stance shifted, with a larger proportion of stocks helping fuel the rally and smaller companies also catching up to their larger peers. The top performing sectors were communication services up 17.3% in the US, healthcare up 16.4% in Canada, and energy up 13.6% in the US and 12.9% in Canada. Although certain technology stocks still did well, others emerged with strong performance. Our top performing portfolio companies in the first quarter were Hammond Power, up 78%, MDA Limited, up 34%, Applied Materials, up 28%, Nuvei, a technology company, up 25%, SNC Lavalin, up 27%, Fastenal, up 16.6%. Now, we refer to this as an increase in market breadth. That's simply a byproduct of a healthier market. Now, our last theme is central banks pushing pause on interest rate cuts. Our expectations for rate cuts in both Canada and the US have held firm at 3 for both banks in 2024. However, if you've been following the market analysts and what they've been expecting in terms of rate cuts, frankly, you might have whiplash by now. In December of last year, Federal Reserve Chair Jerome Powell indicated that policymakers were turning their focus to rate cuts as inflation continued its descent towards 2%. Well, the market ran with this and quickly increased its expectations to 6 rate cuts for 2024. Now, fast forward 3 months and the release of more solid economic data, the market has changed its tune, now anticipating 2 to 3 cuts before the end of the year. Our stance throughout this roller coaster is that the timing and magnitude of rate cuts is a bit less meaningful. What matters more is that rates have a high probability of being lower by the end of the year and even lower by the end of 2025. This will be a welcome development for both consumers and corporations who both rely on debt to fund their future expenditures. Now, a conundrum that isn't discussed in detail is that shelter and used vehicles have been the stubborn inflation culprits. Interestingly, borrowing costs are embedded in both of these figures. So, lower interest rates will lower these costs and inflation, yet central banks are waiting to cut rates until these costs come down. Can you see the issue? It's a bit like a painter saying he'll rehang the pictures on the wall once the paint dries, yet he continues to roll paint onto the wall. Now, thanks for humoring my analogy. Although watching paint dry isn't anyone's idea of a good time, investing in the first quarter has been. With investment returns in the mid to high single digits, we're certainly pleased with this trajectory, but more importantly, with the performance of our investment platform. With stock markets reaching new all-time highs, Analysts and journalists alike seem very unwilling to suggest markets could reverse course. However, we as asset managers do know that complacency is never a good strategy. When comparing market levels to long-term averages, current valuations do present some risk to investors. Now couple this with higher borrowing costs, US election on the horizon, and a laundry list of lingering geopolitical risks. Discipline now is as important as ever. Our focus has always been to manage our investment platform and client portfolios through all market cycles. This does mean a continual focus on risk management, cycle assessment, and utilizing our M-Factor process to find sound companies for investment. Markets in the economy, as you know, are ever changing, but our process remains our constant.